Hi everyone, this is Paul Lang from DTS, and I want to introduce what you're about to watch. It's an hour-long event that was presented live to the free members at Disciplined Trading Strategies. It's called Just Buy Apple, which you may take as being sarcastic or not, but it's not really sarcastic. It's a very, very important and I think educational discussion about longer-term trading investing. This is not about day trading really. That involves the concept of what if you bought Apple in 1990s. Could you buy the next Apple today? How did you go about picking Apple back then? It is a very factual, I did a lot of research on this, and I think a very insightful webinar for you to watch. If you enjoyed this, check out the many other educational events, articles, and Trade of the Week videos. You can get access to those at the DTS Free Stuff page. You can see it if you go to the DTS homepage off on the left. So sit back and enjoy this event. 5 seconds after 5 o'clock. Hello, everybody. Did anybody notice the start time? It said 5.00.05, 5 seconds after 5. We start on time. How's the sound? Can you guys hear me okay? Apollo says, thumbs up. Boy, too bad, Paul. Many times I give away a huge cash prize, so the first person to type on the screen, unfortunately, that's not tonight. That's a shame. Too bad. I think we're going to enjoy tonight. I explained before when I do these, I've a whole bunch of, I've been doing these for 7.5 years, and 7.5 years, and I still come up with topics, sort of. There's just, sometimes they're correlated to other things, they're slightly related. But I always kind of have topics, and I have a whole list of them, and I just kind of pull one out what I feel like talking about, and I usually have a bunch of ideas, throw it down. It usually doesn't take me long to pull together a presentation. I've been doing it a lot, so it just takes me not long at all. But sometimes, like this one here, this is a weird topic maybe to some of you. I think it's going to be a fascinating topic to some of you. And for those of you that don't know me, one of the things I try and emphasize is that when I talk to you, I try to differentiate if I'm giving you my opinion or if I'm telling you something I feel is fact. And if it's fact and it's not readily believable, I want to prove it to you, right? Eric, you hear me say it a lot of time, right? I want to prove to you so that when you walk away, you just cannot argue with me. And I wanted to make this one of those that it's going to be proven to you. Now, what's my point? Well, it's not a big point. I'm not here to convince you of something, to sell you something, to anything else. But I think it's a very, very important point, one that people don't pick up on sometimes, one that can maybe hurt longer term careers. This is mostly about longer term tonight. Obviously I like long-term investing, I like day trading, and this one is more focused on long term. I don't think you can even really apply it, not really, to day trading. And that's good because everybody's involved long term. Some people like to day trade, some don't. So there's always a bigger audience for long term. So I'm going to go through this as methodically as I can. And I ended up with a lot of slides here. And like I said, I think you will enjoy it. As always, my goal is to inform you. And as I get to some of the slides here, I did a lot of research on this. Like this ended up taking me a long time. I worked on it last night. By the way, I've had the weirdest thing. I don't really get sick much, but I've had this cold. And I've never seen something like this. It's like a 3 o'clock till midnight cold. It's the weirdest thing. I wake up feeling fine, and in the afternoon I kind of crash. It's been the weirdest thing. I mentioned that to somebody in the room that I've not been sending stuff out at night. I've been doing in the morning. Anyways, I think it's over. I feel better tonight. I had to do a lot of stats, and when you look at these stats, if something is off or it's a little, you'll get the idea. I mean, you may look at something and maybe I put a percentage down from something over the last 20 years, and it's off by a few. Well, I don't know. I mean, I try to make it as accurate as possible. The point is, if something's off, it's not there to deceive. It makes no difference at all at the end of the day. My point will be made either way. And I started doing this because I know the truth, and I wanted to prove it about this topic. And actually, that phrase up there, just buy Apple, it actually is kind of what the story we'll get to is. It's really kind of, I know somebody that says that. It's kind of a friend of a friend. Don't really know him that well, but his whole thing to investing was, well, I have Apple. All you got to do is buy Apple. You're done. So what do I think about that? Let's get started, and you'll see where we're going with this. Like I said, I'm really looking forward to presenting it, so hopefully you're going to enjoy listening to it. Sarcastic title, I forgot what I said here. Not really, but you'll have to tune in and listen to get the full gist of what this is about. It really applies more to long-term trading. Discussion I touched on several times, and I've done some prior educational events, but I think it deserves a full discussion. Yes, I mentioned this in the intro class. I mentioned it sometimes in other of the free events. Touch on it lightly, but I really want to go into it in full discussion here. Picking your own stocks for long-term portfolio is easy if you get that right until it's not easy. We'll take a look at Apple as an example, blah, 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 blah. Now I'm bored with that slide. Does anyone own Apple since 1990? Is there anyone that owns Apple since 1990? I'm not really asking you, that's just a rhetorical question. And the answer, yeah, of course some do. Some people do. Now, for some of you listening to me, you may be saying, well, yeah, of course. And some of you listening maybe say, that's nuts. Nobody could possibly do that. Don't forget that there is a group of people that are just kind of started investing in their 20s and they've never ever looked at their portfolio. They never would ever sell anything and they're waiting to retire. What do I think of that? I think that's phenomenal. I think that's actually the way to do it, to be honest with you. As a matter of fact, my first podcast. What, Paul? You do podcasts? Yeah, I do podcasts. On the website, you can access the podcast if you want. Before you ask, because I know you're all going to clamor and ask, I'm on podcast 57 or something. But on the pilot podcast, I actually talk about this concept. That despite what I like to do, yeah, just buy GE. Despite what I love doing, I think the best answer really is to be diligent if you're in your early 20s, late 20s, and put money in the market, every single month and just keep doing it. However, big asterisk, I would not start doing that today. People have asked me as young people, and my answer to them right now today would be to put it in a CD, 6-month CD at a time, and wait for a market crash to start, even if you're dollar cost averaging in, because you'll see why in a minute here. But in general, the concept I think is great, and I think it's actually the way to go. So why don't we call that the end of the presentation? What's wrong with that if that's the way to go? Long-term average in over decades, the market over any whatever period of time is up, blah, blah, blah. If you get in at the right time, you make a fortune. Get the right stocks, you do well. The problem is that what I just described, this really kind of nice way to do it, just put your money in, don't worry about getting too educated in the market, do something else, retire early, that's great. The problem is that 93% of the people are not in that situation approximately. Now, this depends on, you get into surveys and stats, basically meaning that only 7% of the people who are nearing retirement say, yeah, I feel good about retirement, I'm set. 93% of the people are not there or not anywhere there. And this is where the problem comes in, right? Because if you're in your 40s, your 50s, you can't start dollar cost averaging into the market really. You got to be more careful. I'll show you why in a minute. But as you get too late, you got to be more careful on where the market is right now. And that is the problem. Because so in other words, for those people who did that, I joke in the podcast, congratulations, except you're not here listening to me, right? You could care less what I have to say. You're just like, hey, I hung on the stocks for 40 years. I'm doing great. You guys are all idiots. And to some extent, they're right. But if you're not that person, and the problem then becomes people try to accelerate, right? By getting in, getting out, holding shorter term, which can be good, but can also be terrible for people because typically people never catch the full bull run, and then they think it's too early to sell, or they short too quick, and for the average person who doesn't know what they're doing, any kind of market timing is usually deadly, and that's a stat that's out there. It's pretty accurate. So that's what I'm talking about here tonight to some degree. And of course, somebody who maybe had stocks for 40 years, maybe part of that portfolio was Apple, just something that they bought. So has anyone owned Apple since 1990? Here's some stats on Apple. And by the way, it could be something else. Boom. Look at the chart of Apple. All right, you can't even see 1990s. I'll give you some better numbers on it. That's the chart of all you need is one apple. It says there, right? All you need is one apple, and you're all set, right? Just go find an apple. You're all set. Let's read some of these. The lowest for anybody who doesn't have Apple for 40 years, we can all get sick reading this, right? Did he have Apple? I only saw that movie once. The lowest closing price for Apple all time was 4 cents on July 8th. The latest price is $2.36. Now keep in mind, when you see some of these numbers, they're adjusted for stock splits. So if you're saying Apple's $2.36 today, then the low price is 4 cents. If you go back and look, it won't be 4 cents, because of stock splits. So it's adjusted. How much were Apple shares when it started? $22 per share. Apple went public in 1980, $22 a share. The stock split 5 times since the IPO, so the adjusted price is 10 cents. So there you go. So if you adjust down from the real price of 22, it's actually 10 cents. Thank you very much. If you had $1,000 invested in Apple in 1984, what would it be worth today? If you invested $1,000 in 1984, you would have $1.5 million. There you go. $1,000, one-time investment, 19, that's all you needed. I mean, at least it's 1.5 million, maybe not all you needed, but heck of a start, right? Likewise, if you had invested $1,000 in an index fund, you'd only have $55,000, and $1,000 in the S&P would be $29,230. NASDAQ's the place to be. What if I invested $100 in Apple in 1980? $100 investment would have bought 4.54 shares of the IPO price. You'd be the lucky owner of 254 shares of Apple, worth $67,000. There you go. And just for a funny note here, one of the first Apple computers ever made was recently auctioned off by Christie's for $500,000. That's interesting. I didn't know that. The things you find out. Now, I always bring up Apple as an example because I kind of had a personal feeling for it, personal touch for it, if you will. And that's because when I started using a computer, I started using an Apple. Probably because the company I work for, but remember I've only been trading since 1999. So before that I had a life. And at one point I worked for a company and my boss used an Apple. So I kind of saw what he was doing and like that, and I was going to get an Apple. And I knew a friend, who was kind of into computers on the PC side, right? So I see my boss using an Apple. You want to go into the hard drives, there's a picture hard drive, you double click it, dude, and you go in it. And back then, when Apple looked like that, in a Windows computer, I'd say, well, okay, how do you access that file? He goes, oh, it's easy, /C /, override, backup, blah, blah, blah. And you're like, what? How do you know that? Well, that's just where it is. And everything was like that. You had, where's the book on this? I don't know. So to me, it was just a ridiculous comparison. Let's make it clear. Apple was always a superior computer. Apple, I don't know if today anymore, but it was a superior core computer all through the 90s. I had to switch to a real computer because when I started trading, you could not trade on an Apple because everything was written for Windows and there was no, workable, translatable software. I guess there is today. I really don't know. So they had the best computer, unquestionably by far. And if some of you want to agree with me, feel free. If you don't want to agree with me, just shut up and don't say anything. No, I'm just kidding. But most people would agree with that, right? I don't even know who had spell check. All I know is it was usable. For somebody who didn't know computers, they were usable. But here's the problem. You could not give them away. You literally could not give them away. The question is, all you needed was one Apple, but how simple was it to buy Apple back then? Now, I don't mean, oh, I want to buy Apple. How can I buy it? Obviously, you just buy it. But I mean, to find the Apple, before you know it's Apple, how easy is it to find the next Apple, right? The stock. So here's some history of Apple. I want you to go back to the 90s. Here's what Apple Computer was to everybody. It was considered to be the most expensive anchor for your rowboat. It was considered to be the most expensive alarm clock you'd ever put next to your desk. Yeah, right, Pierce. To me, it always has been. But what they do is they come out with inventions, and Windows would steal them, and Windows would market it. For some reason, Apple couldn't get their hands around it. And I'm not exaggerating. And like I said, I have memory of this very clearly because I was kind of frustrated because I knew they were great computers and I stopped using them. I had to. And then I see them struggle. And I'm like, what are your commercials? What are you doing? They had the stupidest commercials. And, it was one of those biggest mysteries in life to me, how you could be given the best product and you couldn't give them away, literally. All the Mac now supports Windows. That was the joke, So it was just a comical thing the whole time with Apple. Apple flowchart, take it to the Apple store. Did that fix it? No. Proceed to step 2, buy a new Mac, overdraw your account, quietly weep. That was kind of the joke also back then. While Apple computers in the 90s were considered to have a good design and user experience, they were generally not considered good compared to the competition due to significant challenges like losing market share to Microsoft, struggling with networking issues, facing a price disadvantage, making them less competitive in the overall market, especially for business use. The company nearly went bankrupt during this period. It was the most hated stock on Wall Street. Now, of course, anybody who has Apple today would never remember that, say that, know it. My point is, I'm getting to it. I forgot these slides are really nice, so I don't have to jump around. It was the most hated stock on Wall Street. I remember it clearly. I remember when they were talking about Apple's going to go under. I remember it on TV. When did Apple almost fail? It's hard to believe that one of the world's biggest companies by market capitalization was once in dire straits. It never actually filed for bankruptcy, but it was on the verge of going bust in 1997. Now, keep something in mind. In 1997, that was during the heyday of the bull market, right? You could throw a dart at any tech stock out there and you'd be hauling in money, and Apple couldn't give their computers away. Amazing, isn't it? 1997, Apple's market share for personal computers was 3.3%. 3.3%. This is a significant drop from 5.4% the year before due to declining sales in Macintosh sales. Apple shipments dropped 31%. Blah, 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 blah. So my point I'm getting at on one side is, okay, going back then, why would you know to buy Apple, right? There were a ton of great tech stocks out there, and some that certainly look better than Apple. Take iOmega, another company I remember very well because I traded a bunch back in my first year trading. iOmega, anybody know iOmega? Anybody know iOmega? Anybody know iOmega? You know the name? They're not around anymore. You know the name? Okay. So back in the day, I hate that expression. I don't know why I say it, but actually I never did this because I had a Mac, and then when I went to PC, I went to an iOmega. But you have floppy drives, right? And could somebody tell me if you've been around for a while, like what's the most floppy drives you ever had stacked up on your computer? I remember seeing pictures of people with like 50 of them stacked up, right, to back up your computer or something like that. So you have all these floppy drives that hold like nothing. And then iOmega comes out with a zip drive that holds 70 to 100 standard floppy drives. Holy cow. And I remember I started trading this. This is a $4 stock when I first saw it, whatever. Anyway, I never held it. It was just, day trading it. It was kind of a fave. And I think it went over $100. I'm not sure if they ever had a profit or not. I don't remember. And then I got a deal to go on virtually every computer as standard equipment, right? Slam dunk, best investment you could ever have in the 90s. Best investment ever. Look at this thing. It went from zero as a penny startup company to about 140, right? And that's all in, pretty much all the move from 96 to 97 for the most part, right? Wow. And then what happens? Until 900 megabytes, somebody invents the CD-ROM. It actually was, I guess it was a company that did that, but this type of stuff, I always say two kids in the garage can invent this stuff. And what happens to iOmega? Well, here's what happened to iOmega. So what if iOmega was the stock that you picked? Well, you'd be bust. And why would you have picked Apple instead of iOmega? Now, I know it's hard to think that way because you think Apple, my God, it's the best company in the world. But not then. It sucked. It was the worst company on planet Earth. You would never have bought that based on any kind of anything. No way, no how, no way. Okay, Paul, you picked on one company to make a point. Apple, iOmega, all right, maybe I wouldn't have picked Apple. But is that really a fair comparison? Couldn't you have just bought stocks in the late 90s and just be retiring on the stocks that you bought? Well, let's take a look at those. Let's go back to 1999. You ready? Told you I did a lot of work for this. I wasn't kidding you. I did a lot of work for this because I was partly curious. I wanted to make sure, that I was proving what I was saying, and beyond that, I was blown away to some degree. Here are the top stocks of 1999. These are the hottest stocks of 1999. There's a percentage increases from 7,900 down to 511. The top, I don't know if that's 15 or 20, whatever it is, top stocks. Some of these names you might recognize, right? There's Qualcomm. Qualcomm in that year was the second hottest stock. Can you believe that? Amazing. Probably a harmonic lightwaves, I know. F5, there's F5. Netscape wasn't one of the hottest stocks of that year, obviously. It was around. It just didn't do a 500% return or better, right? What about America Online? There's another one, right? Is America Online even? No, they got merged or bought or something, whatever it was. At one point, can I tell you the America Online story real quick? Our 500% return. These are the hot stocks that year. I mean, sure, they were great over the 90s or whatever. America Online had just flown higher sometime when I started trading my first year, and I decided to short it one day, right? It was just one of these parabolic things, And I shorted on a Friday, and guess what happens on Sunday? Barron's comes out with an article, amazingly, just like it's like I'm God or something. They come out with an article saying that America Online is so overpriced that it is fairly priced if every person in America was using it. Do you know how crazy that is? Right? Yeah, I think I do too. Yeah, because they still have the email system. You're right, I still do too. So I shorted the stock on Friday. On Sunday, Barron's comes out with an article saying that America Online is so crazy overpriced that it's fairly priced if every person in America was using it. I'm like, wow, this thing is good. You know what it did? It went up on Monday. I had to sell it. And if I didn't sell it, I'd be broke because the thing just flew higher and higher and higher. Anyways, so much for that one. So here's all the companies. So the question is, of course, I'm going to keep reminding my point. My point is, Paul, the sarcastic point I'm trying to put down is, Paul, all you have to do is go back and buy an Apple. Okay, so I'm questioning how easy is that to do? If you're in 1999, how would you know how to buy Apple? You wouldn't have bought, but what if you bought something else? Well, here's the hottest stocks of 1999, right? So here's what they did since then. Hottest stock, DNA Sciences, from 47, or again, it's a split adjusted, it wasn't really trading yet, $48,000 to 17 cents. I guess you call that bust. 55, this one, the green dot means that you would have made some money. Amazingly, QCOM was not up that much at all in all that time. It had its run, I guess, before that. Um, $88,000 down to $5, 106 down to 5, 64 to 4, 50. There's another winner. But would this make you retire? Right? This is not Apple, right? This is okay. You made some money over 24 years, 25 years. You tripled your money. Who cares? 87 to 4. You get the idea, right? Is that going to buy, and again, my point is, go back to 1999, try and duplicate the Apple if you don't know what Apple is. Whatever one of these you bought, if you had bought all of these, you'd be broke, right? The winners didn't nearly make up for the losers. So that doesn't really seem like something that would have worked very well, right? Trying to go and pick the hot stocks in 1999. All right, Paul, sure, you're picking the high flyers, right? They're likely going to fall apart. Let's be more reasonable. Okay. Just in general, the Dow started in 1916 and it went up to 30 stocks in 1938. How many of the original Dow 30 stocks are still in the index? Zero. A big zero, right? Again, what's my point? Well, my point is most all of them, when are gone, they're out of business. Some are not. Some are just taken out of the Dow because they weren't doing well. A couple merged and stuff. But basically, if you had owned all the Dow stocks in general from 1938, you'd be broke. How about the NASDAQ 100? Started in 1985. Original NASDAQ 100. How many of those stocks are left? I've never asked this question, and I did not know this answer until I looked it up. How many of the NASDAQ 100 are left? Because here's more recent. Yeah, okay, Dow, about 60 years ago. How about the NASDAQ 100? That's only, 35 years ago. How many NASDAQ 100s are left? Nobody knows this one. I didn't know it. I just never ran across it. 6. There's only 6, and you probably know the 6 because they're the big 6, right? So again, the point is, how did you know to get one of those 6? How did you know? I don't know how you would know. I don't know. So right now, I bet that all of you listening to me have one ear to me and one ear to the TV because you're doing well. Because you've done your research for your long-term portfolio right now. Maybe you gave it to some guy. Maybe some guy is managing it for you. He's doing okay. But if not, you've done your research. You've used fundamental scans to find the best fundamental stocks. You've searched recommended buys and sells from brokers. You've reviewed the PE ratios. You've examined past income statements. You reviewed future predictions. You use a bunch of technical indicators to time things, right? But you know what? There is an alternative method you could have used from this page here. You know what that alternative method is? Yeah, you could have followed Nancy Pelosi too, right? Yeah. You know what the alternative methods are that are simpler than these? You ready for this? You could have picked the name out of a fishbowl and you could have thrown a dart at a bunch of names on the screen and picked one of those. Or like I always joke, you could have just gone with the favorite color logo of whatever company it is. So why am I saying that? Why am I putting down people who do all this research and stuff? Well, it's very simple because here's the truth of it, and this is the whole point I'm trying to make. You can do all the research that you want, but the truth of it is, it's this correlation. You're not really finding winners. What you're doing is you're betting on the decision to be in the market. If you're in the market, you can pick the index, you can pick some stock by any method you think works, or you can randomly pick a stock and you're probably going to make money. Does everybody get that point? Does everybody get that point? I mean, some people think they're geniuses because they have a portfolio that's doing okay, but maybe it's not even doing as good as the market is. Right? So my point is, the real decision is be in the market, don't be in the market. But all this individual stock picking, in other words, trying to find the next Apple is not really a doable thing in reality, right? It's just something that all this thing we do to pick stocks, if you're doing it by this type of method, if you're looking for fundamentals and that type of thing, All you are is, if you're doing well, you're likely riding a bull market. The question is, no matter how you pick it, it will likely come out the same, no matter how you pick it, right? No matter what method you use. If you're in a bullish market and you're buying stocks that are market type stocks, you're going to be okay. You may be a little better in the market, you may be a little worse, whatever it is. But you know what? All you had to do is throw a dart, to be honest with you. You really did. I told you the story when I first started. One of my first, wake up calls, the very first month or two I was trading, it was back in the days where I still had paper magazines, 1999, and I had five of the top of the money type magazines, Kiplinger's and Money Magazine and Barron's and whatever, blah 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 blah. And I went through, like, at the end of the year, and I went through, they all had the top 20 pick, top 10 pick, whatever it was. And I picked over five magazines. I took their top 10 of each one. If they had more than 10, I took the top 10. And I tracked the 50 stocks over the next 6 months. Guess how those 50 stocks did? 50 bullish calls in a bull market, 1999. Guess how they did? They were dead flat. They were dead flat. Terrible picks. And I'm thinking, okay, what goes into deciding what to buy these, right? And a lot were simply because they were great stocks, but they had topped out, right? If everyone in the world that's ever going to buy XYZ has bought it already, how can it go higher? And that was the problem with a lot of those. This is why you need to learn charts. But let me go on some more here. The real test is what happens when things aren't so cheery, right? We're all riding a bull market, and this is a world record bull market. What happens when we're not riding the bull market? What's going to happen? The crash of 2008 took the QQQ market, this is the NASDAQ, from 55-ish to 25-ish. There's right from my screen. I pulled this from my screen. 55 to 25-ish, very, very quickly. Which stocks survived? Did your stock survive? How did you do? How would you know? How about the 2001 crash? Took the QQQ NASDAQ 100 from 120-ish to 19-ish over 18 to 24 months. And, are you ready for this one? If you went long here, it took you 17 years to get your money back. Now, this is part of the big point I want to make. If you're in your 20s, you kind of, I would not start today. But, like I said, if you're in your 20s and we're in 2000, I'd be saying wait till the crash. If you started here, you'd be doing incredibly well. But wait for a crash and start. But the point is, even if you didn't, if you're in your 20s, early 30s, you'll recover and you'll probably be okay. But if you're 40s, 50s, and you decide to start here, guess what? You could be 70 before you get your money back, let alone retirement money. So this is a serious topic. And continuing on, see that huge crash there, everybody? That was 2008. Probably most of you remember that. I mean, it's only 15 years ago, right? 16 years ago, 17 years ago. Everybody probably remembers that. Maybe you all didn't have money in the market or weren't that in tune with it. But if you had money in the market, you're well aware of it. And that was a nasty crash, right? Agree, everybody? Nasty, nasty, nasty crash, right? Brutal. And actually, it turned out not so bad because it recovered fairly quickly. Maybe they had a cartoon on TV about it back then, yeah. So, but the crash was terrible, right? 2001 took 17 years. This one came back a lot quicker. But still, and the problem is, it's like, if you look back and you just stuck with it and you go, oh, no problem. But how did you know down here if you weren't going to fall even more? How did you know, right? If you're shorting it, you're great. Now, again, look at that chart, right? Nasty, nasty crash. You ready for this? There's a monthly chart of the NASDAQ since 1999. Here's the scary part. Where is that crash? Where is that huge crash of 2008? Do you see it? There it is. Now that should get some OMGs out of you. Yeah, Eric, you got that from me, unless we talked about it before. That is the crash of 2008. You can barely see it. It's a whoops, just a little hiccup in the road, right? Yeah. Some of you should be falling out of your chair, and of course you can see where we are. So my point is just simply a helpful one. That number one, this is where we are. I don't need to know anything about charts, technical analysis of the market, other than to tell you there's where we are. Use your common sense. And number two, this concept of looking for the next apple, which is such an important thing. Well, I'll get to that in a second. How will you fare in the next crash? Do you have 17 years to the next recovery? What I always say to you, and I said it before, so I'm not going to ask you the question, but what are the odds? What are the odds the market will crash? And I mean have a bad crash. What are the odds? The odds are 100%. It's a mathematical certainty. There is no question. Maria Bartiromo said, "Oh, can we trust the market now? Will the market never crash again?" Well, that's ridiculous. It is. Don't take it the wrong way. I love the market, but the market is a Ponzi scheme by any definition that you use, and it will crash because it has to crash. That's what it'll do. The question is, how will you handle it, and what will you do when that happens? Unfortunately, I've seen this happen, 2 to 3 times to 4 times in my career with people. Right? Bull market. Hey, I'm okay. I don't need any help. I'm doing great. Things start to fall. Well, I'm in pain, but I'll be okay because I know what to do. And I need help, but I can't because I'm broke. In 2002, 2003, E-Trade was the #1 broker at that time. And they had, and I forget my 90s mixed up, I'm sorry, 92, 93, 94% dormant accounts, meaning they're broke. The bottom line, I'm on the bottom line already? How did this go so? I was really worried about running over. Boy, was I ever off. Well, these next two slides will take a while. Let me know if you have any questions. But the bottom line, to have Apple, and you don't know anybody to have Apple, right, what I'm saying now? No, I know somebody that does. I don't know what year they got it, but they got it in the 90s somewhere. Yeah. And hence the title to me, because that's what he says to me. Is just, well, I have Apple. It's all you have to do is buy an Apple, But other people think that too. So anyways, all right, sorry. I guess the slide I'm missing is coming up. I don't know. I'm confused. Who did these slides? So to have Apple is generously a 1 in 100 shot, right? I think I've shown that. It's 1 in 100. If you have Apple and then held it for 20 or 40 years, it's rare. So in other words, even if you got it, even if somebody got it in the 90s, who held on to it for 40 years? If you did happen to have it at the right time. Here's a big one for me, and another big part for this presentation for me, is that many go broke constantly looking for the next Apple, which is by definition hard to find. And when they do find it, they don't know how to handle it. Like the dog chasing the car. The famous expression is, if the dog ever caught the car, he wouldn't know what to do with it. Many go broke looking for the next Apple. I know of somebody, not personally, but I know of somebody that had a home run trade on, some little stock. I don't know what it was, like some little biotech or something, some wild, lottery stock, and they cleaned up on it. Like we're talking retirement money, probably, cleaned up on it. And you know what that turned out to be? One of the worst things in his life. Because what do you do? Let me ask you a question. If you won $5 million in the lottery tonight, if you won $5 million in the lottery, what would you do with it? What would you do with it? You won $5 million in the lottery. You give me half? Well, that's fair. That's what most people say, Rob. Yeah, I appreciate that. Thanks. I mean, you'd probably take $1 million and buy a nice house, right? Take a couple, $3 million, and set yourself up, right, in a long-term interest-bearing thing so that it pays your bills for the rest of your life, and then maybe you can play with $1 million or two, right? But who would take $4 million or $4.5 million and buy more lottery tickets, trying to get more than $5 million, right? That's what some people do, to give you an analogy. In other words, I know somebody had a winning stock, and you know what they did? They kept going after trying to find another home run stock. And they never got it again, never. Just everyone went belly up because they are 1 in 1,000 type things. Getting an Apple is literally, an Apple stock is literally like winning the lottery. That is what it is. I think I've proven to you, in reality, it's extremely lucky and difficult to find. Now you can tell me no, you can tell me you got all this stuff going for you, but you tell me how many of these make whatever percent return was on Apple. What was it? $1,000 investment at the right time was $1.5 million. Learn how to read charts, take major moves from stocks, and manage them properly. This is my suggestion to do it better, is rather than going for the home run and whatever, especially in this time in the market, is understand how to read charts. Get the major move from the stock that you're working with, from the couple stocks, from a few stocks, and then maybe get the major move, maybe hold a little bit, and then move on to the next thing. And be a little more flexible, because that's how you really make money over a longer period of time, not going for that one home run. Now again, remember I started this talking about the person who starts dollar cost averaging into their 20s. I think that's great. So I'm talking to the 94% of the people that are left out because they didn't do that. and are looking for a little faster gains, you got to be careful because a lot of people shoot themselves in the foot, losing more money than they make. Well, I had a note here, and I didn't know if I was going to say it or not, but naturally, manager is right in front of you. Naturally, IRA or tax implications may make you be not as nimble, and you may have to take offsetting positions to do that, or you may have to not care about the tax implications, depending on what it is. But you may just have to offset them with something, if that's what it is. But, and I'm not saying that you should be holding short term necessarily. What I am saying is that you can't just hang on for the next apple because most apples are not going to be apples. Understand that even the greatest stock of all time will hit its highs and lose money for you every day after that. Did everybody hear that? Even the greatest stock of all times will hit its all-time highs and lose money forever. See these charts over there? Just a couple of examples. Top up there is GE. GE went from, split adjusted 470 down to $50. GE was the greatest stock in the world. You look back and say what you want about it. Since then it's recovered somewhat, but you would be just completely, hanging yourself if you invested in GE at the wrong time. It was the greatest company in America. Check anybody back in the 90s? It was the greatest. Matter of fact, GE, you know what GE was called? It was called the market. It was called the market, right? Greatest, and there it is. If you bought this here, if you bought the greatest company in the world in 2001, you lost 90% of your investment over the next several years. Still was the greatest company in the world. Even more recently, look at Intel. You guys see Intel, right? One of the great tech stocks. You certainly would have bought Intel before you bought Apple. And look at Intel. Intel went from 70, this is right off my charts, 70 down to 19. I didn't realize how bad that was. And this is in a bullish environment, right? So it doesn't matter. Yeah, right. I know, Eric. Yeah, I know. And then of course people look back, and then of course they give me all the reasons why this stuff happened. They tell me what Intel and blah 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 chips they never made vinegar chips. They should have made vinegar chips. And GE, Jack Welch, blah blah. Yeah, okay, great. Everybody in hindsight's a genius always, right? But the point is, when this is happening, do you really react to it? What happens? So this is the typical thing that happens. And what I suggest is, if you have that dire desire to, go for that home run thing, is take 90% of your money where you're more conservative and going for solid stocks for solid gain. I was going to put some stuff from the long-term trader in here, but I didn't want to do that. I didn't want to make this about DTS. It's just kind of a general talk to everybody. But whatever you use for your long-term stuff, be a little more conservative. Be happy with some really solid gains. If you pick stocks properly, and this is the whole thing, the theme to me is that if you're doing it on your own, learn how to read charts, learn how to understand charts, learn how to pick stocks properly, learn how to get good moves, learn how to find money, even shorting some stocks while the market's going up, learn how to be balanced, learn how to do this so that you can make a really great return over whatever you're working with. Because going for the home run means you very rarely get it, and it means you're just wasting your time, money, energy, and money most of the time. If you have to go for that home run, just take a small account and go for that crazy biotech stock that your friend of a friend's wife, ex-husband recommended to you because he knows somebody that used to work there. Use that with a very small amount of money, because if you get the home run, you get a home run, and the odds are not. Let me give you my last stat here on this, and this one should amaze you too, right? My last stat. You ready for this? In all the time that I've been doing this, which is getting to be a long time now, over 2 decades, I've naturally have had a lot of people who have sent me quote unquote tips, right? Because they want to thank me. They want to help me. They say, Paul, you know what? I work with this company. I know the guy still, blah, 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 blah. I know this, I know that, I know that. And here's a stock for you. Don't, some people even call me because they don't want to put it in writing, because they're maybe afraid they were going to get in trouble or something, right? I don't even know how many I got. I don't know. Let's say I got 300. I don't know. How many of those made money? You know it's going to be low. 20%, 10%, 5%. You ready? I'm not kidding you. Absolutely, positively zero. Now, out of the couple 300 that I got, I did act on 2 of them. I acted on 2 of them, small amount, and I lost money on both. But I track the rest. Somebody says that to me, I'll put in a watch list, and just see if they know what they're talking about, just to know, just to say, hey, maybe I'll listen next time. Never, ever. It just doesn't happen. Normal people walking, think about it. Again, this is common sense. Normal people walking around giving tips don't know what they're talking about, right? Where do they get the information from? People that really know something, they're not telling people, right? They're not spreading. These are all idiots that like to talk and they have friends of friends and no friends of friends and all that kind of stuff. Yeah, internet. Yeah, I got a great tip. I just read it on the internet. That's about what it's like sometimes. So I don't know if this, really hit. I'd appreciate comments. I don't know if this really hit home with you big time. If it was boring to you, if you didn't get it at all, whatever it was. I think there's a huge message in here. I think it's a helpful philosophical topic. I do think, yeah, all I'm going to say is the bottom line is learn how to read and understand charts. You may have a false pretense of doing well because you're bullish in a bullish market. And I'll guarantee you this, nobody knows when. I'm still bullish, by the way, but the bullish market will not last. And I'll guarantee you that the next crash, whenever it is going to be a doozy. Going to be a doozy. In 2009, matter of fact, a couple of people who have other companies like mine frequently mention me and give me credit because they said in 2009, 2010 that we would have a decade-long bull market at least. The person didn't believe me, and some people have told me, the guy says in his chat room, he says, man, Paul, he nailed it. The next crash is going to be a doozy. Off the chart doozy. Like, never put your money in the market again, which is when you should put it in again, right? Well, yeah, and that's what I'm saying, Art. I'm not there now, and don't get the wrong impression of this, all these slides about markets crashing. Yeah, I'm not there. I'm still bullish right now, but I'm also being smart, and that can change in a week. Everything can change in a week depending on what happens. But right now, things are still gun ho to the upside, and even more so looking at what's happened the last 2 weeks. So, all right. I've never finished this early, but I'll gladly take any questions or talk about whatever you want to talk about. If you have anything to talk about. I know I left one slide out, but it wasn't all that important. So the title wasn't sarcastic. I'm waiting for your comments here. It wasn't sarcastic. I mean, yeah, if you bought Apple, you'd be rich. But you just can't duplicate. You just can't do that. It's not a plan. Can you explain that slide about taking fish out of a bowl? Yeah. My point of this slide, Art, was that if you are going long in a bullish market, you can pick a stock by doing a whole bunch of crap that really probably doesn't matter. Obviously, the thing to do is look at charts, but I'm kind of making fun of people who don't look at charts and do all this other garbage. I'm saying you could go through this whole process of fundamental review and listening to analysts who don't have a clue what they're doing and blah, blah, blah. Or you could just throw a dart at a board. In other words, you could pick a name out of a hat. You could put 100 stock names in a fishbowl and pick one out, and you'd probably do just as well, because basically in a bull market, things are going up, and you're probably just as good randomly picking as you are doing all of your research, if you're relying on that. Naturally, and I don't want to sit here and pound the table on it, but you guys know, to me, not to me, to anybody, technical analysis is the way to do this. It's the only way to do it for 99.999% of the people. I'm not sure if that's what you really wanted me to do, but thanks for the question. It gave me a little more talking time. Anyone else? What else you got? More people typing. That's my point. It would do just as well. But my point simply was that you were lucky if you picked Apple. This slide here, those are the hottest 20 stocks of 1999. And basically most all those are bankrupt. So my point is that it's easy to look back with hindsight and say things like that, but some of those great companies went to zero. It was very hard to tell at the time. Yeah, I mean, visionaries, okay, that's a great term, but Apple was also the most hated stock on Wall Street in 1997. It basically was a day away from going bankrupt, right? So that's my whole point, is it's easy to look back and say things like that, but the truth is when you go to pick companies today, so what would you do today? Oh, you know what I didn't put in here? Yeah, I meant to put a slide in here if we were going to do this today. You know what somebody emailed me just about a month ago or so, maybe it was more than a month ago. They just read this great new thing and they want to invest it. You know what it is? Okay, are you guys ready for this? Are you sitting down? Camille, are you sitting down? You just said you're big in the high-tech sector. There is a process by which you can run a car on water. It separates the water from the oxygen, and some kind of energy comes out, and you can drive a car on water. Isn't that incredible? It's true. It's a technology out there that does it. And they just read about this. There's a company called Ballard Power and a couple others. Yeah, it's true. I know. And this guy wanted to invest in Ballard Power because he just read about with this great technology. Ballard Power's been around since the 90s, and it went from 500 to zero. I mean, this is what I mean. You know, some of the stuff. How could you not think that a water-powered car would be phenomenal. That's visionary, right? But I don't know why it doesn't work. You know, the major car manufacturers, at least two of the three of them had invested. There's Ballard Power, and what are the other two? Fuel Cell, and another one, right? I don't know the names of them all. But two of the major car companies, Ford and GM, I think, bought major stakes in these companies. And they were up in the hundreds of dollars, and they went to zero. So this guy just found out about it. He's acting like this is brand new news or something, you know. So that's what I mean. How do you know? How did you know? You don't know. That's why you have to follow charts. That's why you have to, you know, if you would have followed a chart on Apple, you would have been long at some point. Depending upon your duration, well, you would have got out and had to get back in again at some point in 2001, whatever. But you know, managing whatever it was, you could have captured huge runs. But it's not knowing you're carrying its Apple. It's not knowing you're carrying its Ballard Power. It's not knowing what hydrofusion is or anything else. It's just simply understanding. Let everybody else figure that out and follow a chart and figure out what to do is my point. And that's why we shouldn't try to figure it out. We just wait at the top of the fishbowl and wait for the winner to emerge. And then we try to follow the winner. And that's what reading charts is all about. All right. More comments? Big picture question. The only thing I've always said, though, is a financial planner, Doge, will always look at the market as being a risky investment. And it is the way they do it because they'll just put it into an index or whatever. But if you know how to trade stocks in the market long term, that market doesn't have to be the risky part. In other words, you can say, here, fine, do what you think I should with my money, put this much into bonds and this much here and this much there. But that stock market part, you know, let's be aggressive with that and let me handle that part. That's what you should do, I think, in my opinion. But learn how to handle it, obviously, right? But the amount of money you need, so it's all a big flexible number based on your lifestyle, how aggressive you want to be, right? Yeah, to some degree. I mean, obviously, you know, the critical mass would be is if you could put your money just in the bonds at 4% or whatever and walk away and have more than you want coming out of that. But, you know, then at 4%, you need a big, big number to do that. So Bubba Gump won't crash. That's going to stay up there. Bubba Gump is going to be hanging right at the highs, even in the market crash. Any questions? And feel free. I talk about a lot of stuff here. I don't want to give the wrong impression or anything. I'm just trying to give a very useful presentation for everybody. Forrest Gump 2.0. You must literally like Forrest Gump a lot. I don't know. Nobody's typing, so I'm calling. I didn't call it because somebody was always typing. Thanks for joining us, everybody. Next free thing for everybody would be next Monday would be scanning for everybody. So we'll see you next Monday. For those of you that are just free members, trading people will see you in the morning. Summer people will see you Saturday for Mastering Advanced Tactics, my favorite class. If you go with the Mongolian camel futures, I suggest you go out to next year sometime, all right? Because they're going to take a while to develop. Trust me. Yeah, that was a well-deserved compliment. Thank you, John. I did put more time into this one than usual because I wanted to, you know, make my points clearly and convincingly. It's a tough topic to get across. All right, buddy. Have a good night.